Welcome to Value VestDaily. Today, we are diving deep into one of the most important economic reports of the year, the IMF's 2026 World Economic Outlook. Our whole goal here is to take all this complex data and translate it into a clear, actionable value investing playbook for you. So the International Monetary Fund has just released its first big forecast for the year, and it's painting a really fascinating picture. They're projecting this steady, surprisingly resilient growth. But, the headline never tells the whole story. Beneath that calm surface, there are these powerful currents moving in completely opposite directions that every single investor needs to get a handle on. And this brings us to the million-dollar question for all of us, right? In an environment that's somehow both stable and full of challenges, we're talking geopolitical tensions, the double-edged sword of AI. How do we find real, lasting value? How do we cut through all that noise? Well, that is exactly what we're going to break down today. Here's the game plan. First, we'll start with the IMF's big picture view. Then, we'll really get into the nitty-gritty of the numbers on growth, inflation, and the key risks you've got to watch. From there, and this is the fun part, we'll translate all that macro data into specific value opportunities and even some actionable investment ideas. And finally, we'll wrap it all up with the key takeaways to help guide your strategy. All right, let's start with that 30,000-foot view. What's the overall health of the global economy looking like right now, according to, well, the world's leading economic authority? The theme of the report itself pretty much tells you everything you need to know, steadied amid divergent forces. This isn't a story about explosive runaway growth, but it's also not a story about some impending doom. It's really a story about balance, where these powerful positive forces are, at least for now, managing to push back against some pretty significant headwinds. The global economy is holding its ground, but man, it's being pulled in a bunch of different directions all at once. So what's actually holding all this growth up? Well, the IMF points to a few key things. First off, there's this massive wave of investment in AI and all the tech that goes with it, creating a huge tailwind. Second, governments and central banks are still playing a supportive role. Think about all the fiscal spending on big infrastructure projects and monetary policy that's finally taking its foot off the brake. And lastly, the report gives a huge shout out to the incredible adaptation of the private sector, which has gotten really good at navigating all these supply chain shocks and trade issues. These are the engines that are keeping the whole thing running. And here's the most important takeaway for us. This kind of environment, it's like a sweet spot for value investors. See, when growth is steady but not crazy explosive, and you can clearly see the risks on the horizon, the market tends to reward companies with real earnings, solid balance sheets, and those durable competitive advantages. It's a market that prefers fundamentals over flashy stories, and that gives us a chance to find assets with a real margin of safety. This is our turf. Okay, now that we've got the big picture, let's drill down into the hard data. It's time to decode the key figures for growth and inflation and figure out what they're signaling for your portfolio. Here it is, the headline number, 3.3% projected global growth. But what's really important here isn't just the number itself, it's the direction of the change. The IMF actually raised its forecast by 0.2% from just a few months ago. In a world that's kind of been braced for bad news, that little upward tick is a really powerful sign of underlying economic resilience. The global economy is actually doing better than we thought. And this table just brilliantly illustrates where all that resilience is coming from. Let's walk through it. You see the global number at the top, that 3.3%. But look at the divergence. It's huge. The United States gets an upgrade to a strong 2.8%. That's being driven by tech and fiscal spending. China gets a massive 0.5% boost to 4.5% as all that policy support starts kicking in. And then you've got India just holding steady at a blistering 6.4%, making it the fastest growing major economy in the world, period. But then, on the flip side, look at the euro area. Downgraded slightly to just 1.2% growth. That really shows its vulnerability to trade headwinds. This divergence right here, this is where our opportunities are going to be. Now let's talk about the biggest divergent force of them all, artificial intelligence. The IMF basically presents AI as a true double-edged sword. On one hand, if this current boom in productivity and investment keeps going, it could add a massive 0.4% to global GDP. That is a huge boost. But if all this excitement turns out to be a speculative bubble that pops, it could shave that exact same 0.4% right off global output. So AI is both the single biggest opportunity and one of the biggest risks out there.
Beyond that AI coin flip, the IMF flags a few other key risks we need to keep on our dashboard. Escalating tariffs and geopolitical friction, that's still a major threat to global stability. Global trade volumes are already kind of stagnant, which is a worry. And while inflation is coming down, it might take longer to get back to target than central banks want, which could mean interest rates stay higher for longer. And that last point kind of circles right back to AI. The sheer amount of money concentrated in just one sector is a systemic risk all by itself.
All right, with the big picture and the key numbers locked in, we can now move to the most important part, turning all this macro insight into a concrete investment playbook. Let's translate these themes into some real, actionable ideas. So here's a look at 5 ideas that are directly inspired by this IMF outlook. We've pinpointed specific stocks and ETFs that really line up with the report's key themes, everything from tapping into the fastest growing economies to hedging against the biggest risks. And just notice the price-to-earnings ratios here. We're hunting for reasonable valuations across the board. Okay, let's break each one down. First up, the iShares MSCI India ETF, ticker INDA. This is a straight-up play on the IMF's most bullish growth story. With India projected to grow at 6.4%, this ETF gives you broad, diversified exposure across that whole market. Now, for the value angle, yeah, a PE ratio around 22 might not scream cheap in absolute terms, but it's arguably a fair price to pay for access to the world's #1 growth engine, especially when you compare it to the crazy high multiples of some U.S. tech stocks. Think of it as a strategic allocation to global growth. Next, we've got a more contrarian pick, Alibaba. The growth driver here is that upward revision for China we saw, which is being fueled by new policy support from Beijing. They're trying to stabilize the property sector and reinvesting in their own tech. But the real story here is the value angle. With a PE ratio around 12, this is a tech giant that's trading at a deep, deep discount to its global peers. It's what you'd call a beaten-down stock that has some serious upside if those policy tailwinds and economic recovery actually take hold. Of course, the risk is geopolitics, but you could argue that risk is already baked into the price. Our third pick is Caterpillar. This one ties directly back to one of the IMF's key growth drivers, that supportive fiscal policy. All around the world, governments are spending big on infrastructure. And guess who builds the yellow machines that get it all done? The value here comes from its incredibly strong moat. This is a company with a long history of navigating trade disputes, and it's backed by an absolutely unmatched global distribution and service network. You add a strong balance sheet and a reliable dividend to that, and you've got a solid, blue-chip way to play the global infrastructure theme. So how do we play the AI boom without paying a bubble price? Well, you might want to look at Intel. Intel is a fundamental AI enabler. It makes the chips that power the whole revolution. But its value angle is what makes it so compelling right now. With a PE ratio around 15, it gives you that exposure to the AI theme, but with a pretty significant margin of safety compared to some of the headline-grabbing AI stocks that are trading at multiples of 50, 80, or even higher. It's the value investor's way into the tech boom. And finally, we have the Energy Select SPDR ETF, or XLE. This pick is all about dealing with the risks the IMF pointed out. Think of it as portfolio insurance. In a world with geopolitical tensions and the risk of inflation sticking around, energy assets can be a really crucial hedge. And the value here is just undeniable. The entire sector is trading at super low multiples, around an 11 PE. If inflation proves to be sticky or global tensions ramp up, this part of your portfolio can provide some much-needed stability and performance. Okay, we've covered the IMF's report and gone through some specific investment ideas. Now let's bring it all home with the key strategic lessons you can take away from all this. Here are 3 simple guidelines for 2026. First, focus on moats. In a world that's steady but risky, the companies with those durable, long-lasting competitive advantages are the ones that are going to win. Second, diversify to mitigate risks. There's a reason our list of picks was so varied, spanning different regions and sectors. It's so you can build a portfolio that can handle a shock, whether that's a tech correction or a trade war. And third, keep an eye on the macro sentiment. The forces the IMF pointed out, tariffs, trade, policy, they're always changing. You got to stay informed. Before we wrap up, just a necessary disclaimer. This presentation is for educational and informational purposes only. It is not financial or tax advice. All investment strategies and investments involve the risk of loss, so please always do your own research and consult with a professional. So I want to leave you with a final question. Looking at this whole landscape, what's your top pick? Are you bullish on India's growth? Or do you see some deep value in a contrarian China play? I'd love to know, so drop it in the comments below. And also let us know if there are any specific high-risk, high-reward opportunities you'd like us to do a deep dive into next. Thanks so much for joining us for this breakdown. If you found this analysis valuable, please subscribe, like, and share Value Vest Daily to help others learn before they put their money to work.